The stock market has been difficult to navigate as of late. The Federal Reserve is taking measures to address the rising inflation not seen in decades, and many experts predict a potential economic recession in the near future. As a result, major indexes like the S&P 500, Dow Jones Industrial Average, and Nasdaq have experienced significant drops. It can be difficult to determine which stocks to invest in during the current market scenario, but opportunities for gains still exist amidst a downturn. Finding profitable investment opportunities can be challenging when the market is struggling. However, there are still options available for those willing to look. The best stocks to buy now are typically large, established companies with strong competitive advantage, known as economic moat. These companies often offer reliable dividends and are less affected by market fluctuations. Risk-tolerant investors who are looking for options may also consider buying cyclical stocks, which offer discounted prices now with the potential for future gains. Here are a few options for different types of investors to consider buying in the current market. Stock number 1. Amazon.com Inc. Tech stocks like Amazon.com may not be the first choice for some investors in current market conditions, as the company operates in a highly cyclical industry and has seen significant decline in value this year. However, this may also be an opportunity to buy the stock at a discounted price. Despite the recent sell-off, the stock remains popular among exchange-traded funds and mutual funds. Amazon.com is an e-commerce giant with a proven track record of weathering economic storms and maintaining strong fundamentals as seen during the dot-com bubble burst, the Great Recession, and the COVID-19 pandemic. The company's newer offering, Amazon Web Services AWS, has high margins, which can boost the company's average margins. While Amazon.com may face some economic challenges in the near term, it has demonstrated the ability to handle them. For investors who can tolerate the risk and have a long-term perspective, Amazon is worth considering. Stock number 2. Devon Energy Corp. NYSE DVN. Devon Energy is an attractive option for income investors, as it currently is the highest-paying dividend stock on the S&P 500. The company is a well-established player in the oil and gas industry and has a history of strong performance and consistent dividend payments, even during times of low oil and gas prices. It also has a solid financial standing and credit rating. The recent decline in the stock's value due to OPEC's decision to increase oil production presents an opportunity to buy at a discounted price. However, it's worth noting that the stock price may be affected by future events, like the ban of Russian oil imports in European nations, which may drive the oil prices up again. Stock number 3. Meta Platforms Inc. Nasdaq META. Meta Platforms, formerly known as Facebook, has been a favorite among investors on Wall Street. It is the fourth most commonly found stock in EFT portfolios, but it has faced some challenges over the past year. Despite this, the company presents a unique opportunity for investors. Meta is considered a growth stock by many, with a history of solid growth revenue and impressive EPS growth until the most recent earnings report. The company's stocks was known for tremendous price appreciation until the tech sector as a whole faced a decline due to inflation concerns earlier this year. The recent downturns has created an opportunity that is not often seen in the market, a growth stock that can appeal to value investors. Meta is currently trading with a PE ratio of around 12, while the S&P 500's PE ratio is over 19. The stock's PB ratio is also sitting at a 5-year low. However, investors should be aware of some short-term headwinds that may affect the company's performance, such as weak e-commerce spending, the company's rebranding to the metaverse, which may come with some growing pains, and the potential economic recession, which could affect the company's revenue and profitability in the short term. Even with these headwinds, Meta offers a unique opportunity to tap into a stock that has historically outperformed the market in a big way, but to do so at a steep discount to the current market value. Stock number 4. H&R Block Inc. NYSE HRB. H&R Block is a well-known company that provides a variety of tax services, both self-service and full-service options. It's also considered one of the most attractive value stocks in the market. One of the main concerns for some investors in the stock's PB ratio, which is relatively high. However, it is important to note that this ratio is not as relevant for H&R Block as the company operates in the service sector and does not have many tangible assets. Furthermore, H&R Block's business model is relatively recession-proof, as people will still need to file their taxes regardless of the state of the economy. The company is also working on revamping its small business product to increase profitability. Additionally, it offers a respectable 3% dividend yield, which can provide additional income for investors. Overall, H&R Block's discounted valuation, recession-proof business model, and dividend yield make it an appealing investment option in the current economic climate. Stock number 5, ASML Holding NV. Nasdaq ASML. Recently, there has been a significant amount of interest in semiconductor manufacturers like Nvidia and Advanced Micro Devices due to a widespread shortage in the industry, and that is affecting various sectors such as automobiles, computers, and healthcare. However, these companies would not be able to operate without the support of companies like ASML Holdings, which is a leading semiconductor equipment manufacturer that provides tools for these brands and many others. ASML holds a monopoly on the production of extreme ultraviolet (EUV) lithography machine, which are critical in the production of tiny patterns on microchips that are required for data processing. These machines are not only expensive, with ASML earning around $150 million in revenue every time it sells one, but also have high demand, with analysts forecasting significant growth in earnings through the rest of 2022 and 2023. Additionally, recent declines in the stock price have brought the valuation to a more reasonable level, making it an attractive investment opportunity. Stock number 6, Exxon Mobil Corp. NYSE XOM. Exxon Mobil is a well-known name in the oil and gas industry, making it a great stock to invest in to protect against inflation. One way to gauge inflation is by observing the price of gasoline, as when it increases, it can lead to a domino effect where shipping costs also go up, resulting in higher prices for consumers. As the largest gas station chain in the US, Exxon Mobil is a direct beneficiary of rising gas prices, allowing the company to generate increased revenue and profits. While the stock may not be as attractive during times when gas prices are low, it is currently a great investment opportunity. With gas prices rising over $4 per gallon, the company is generating significant free cash flow, and the stock is also trading at a fair price, with a P/E ratio below the average of the S&P 500 and a PS ratio approaching 1. Additionally, the company offers a yield of around 4%. All of these factors make Exxon Mobil a great investment opportunity. Stock number 7, UGI Corp. NYSE UGI. If you've become more cautious about risk and are looking for a stable investment in the utility sector with a strong dividend, UGI is a great option. The company is a regulated distributor of natural gas and propane, with a history that spans over a century. It has a long history of paying dividends to investors with a streak of 138 years and has consecutively raised its dividend payments for the past 35 years. This means that even during tough times, such as the dot-com bubble in 2001, the Great Recession in 2008-2009, and the COVID-19 pandemic in 2020, UGI investors received increased dividends. By investing in UGI, you are investing in a company with a century of experience and a strong track record of paying dividends and outperforming the S&P 500 in bear markets. Stock number 8, Duke Energy Corp. NYSE DUK. As one of the biggest electricity utility providers in the United States, Duke Energy offers a reliable and stable investment opportunity, even in a bear market. The company serves a large customer base across 6 states with both electric and natural gas services. Investing in DUK during a bear market is a wise decision for several reasons. Firstly, regardless of the state of the economy, consumers tend to prioritize paying their utility bills, making DUK a secure investment. Additionally, the company has a history of outperforming the S&P 500 during economic downturns. Although DUK may not be the most exciting or high-growth investment opportunity, it provides consistent returns and steady dividends. The company's main focus is to provide quality and fairly priced services to its customers, and in doing so, it offers peace of mind to its investors. So, to conclude, the stocks mentioned above are considered to be sound investments amidst the ongoing market downturn. They all belong to the large-cap category and generally adopt a conservative investment approach. Therefore, it is crucial to conduct your own research and make information investment decisions that align with your specific circumstances, rather than solely relying on stock prices from online sources, including the ones mentioned above.